digital transformation of music, digital transformation of education, digital transformation of books, digital transformation of storefronts. What I'm saying is this is the digital transformation of money, of capital, of property, right? If you want to give music to 1 billion people, you need digital music. If you want to give wealth to 1 billion people, you need digital capital. You're not going to give money and property rights. You're not going to give economic security to everybody on earth without the digital form of capital.
In an insightful discussion with well-known billionaire and Bitcoin enthusiast Michael Saylor, we explore the revolutionary transition to a digital currency. Saylor offers his perceptive observations on how this shift will play out, and what in today's world constitutes good financial judgment. Saylor asserts that we are only beginning to explore the extent of Bitcoin's adoption potential, even in light of the approval granted to Bitcoin ETFs and the growing interest from big companies. Saylor makes a convincing comparison between Bitcoin and electricity, comparing the two to be both necessary and originally viewed with mistrust. He uses the slow adoption of electricity as an example to remind us that social acceptance frequently takes time. According to Saylor, Bitcoin will eventually be as standard as internet giants like Google, Facebook, and Amazon. Saylor emphasized the significance of understanding basic ideas like inflation, the nature of money, the distinction between credit and currency, property dynamics, and risk assessment as he delves deeper into financial intelligence. Saylor believes that understanding these ideas is essential, as not doing so could lead one to a life of constant financial struggle. Let's hear what his following words.
I think you should think about a shock wave. When the plane is flying slower than the speed of sound, the air can communicate with air in front of it and behind it. The air gets out of the way and you have laminar flow and it's quiet. When the plane goes faster than the speed of sound, it's breaking this speed barrier and now the air can't get out of the way. There's a sonic boom and there's a lot of noise and turbulence. So when you go fast through the society, through the civilization, a lot of people get struck by a new idea they're not ready for. And it's scary and it's confusing. And so in my experience, the best investments, Apple, Amazon, Facebook, Google, they're investments everybody needs, nobody can stop, but nobody understands. And they're scary. Bitcoin is digital money. It's something everybody needs, nobody can stop, but a lot of people, most people don't understand. It's not any different than the first 5 years of electricity. You know, someone invents electricity and they come to you and they say, hey, I want you to put electricity in your house. And you say, well, my neighbor put it in his house and the house burned down. And the mayor says, we're going to pass a law making it illegal to wire your house with electricity so you don't burn down the building. And then someone says electricity is dangerous and it will kill us all and cause cancer. And then at some point they realize electricity it's complicated technology, but life is better with electricity in your house and electricity in your kitchen, and electricity in your hospitals, and electricity in your offices. So that didn't happen in 5 years. It took 30 years. It took an entire generation. And that's what happens with new technology and paradigm shift. This is digital money. You know, my father, he ignored the first 20 years of the internet revolution, and he didn't want an iPhone, and he didn't want a computer. But then at some point, we got him a big screen television, and we got him a handheld device where he could speak to YouTube and ask for anything he wanted to watch on TV. And when he could speak and YouTube gave him his favorite TV shows and favorite musicians and he could travel the world via YouTube, he started loving technology. These ETFs made it 100 times easier to buy Bitcoin, and every day $50–100 million worth of capital is going from analog to digital, and people are buying it that would never touch it. But, you know, when Apple builds Bitcoin into the iPhone, that'll make it 1,000 times easier. When Microsoft and Apple and Google build it into Android or Microsoft, it makes it easier.
And do you see that move coming?
Yeah, it's all happening. Look at Cash App right now. Cash App has got 50 million or more users, and Cash App made it easy for millions and millions of people to buy and use Bitcoin. So you have lots and lots of companies, products, and services that are being built. My company, you know, issues equity and debt, so we sold $1.4 billion of Bitcoin-backed convertible bonds in a week, 2 weeks. Okay, so $1.4 billion gets on the network in a matter of days. Why? Because it's a very special type of application. Is there one killer one? No, there's 10,000 applications. And it's a competitive market, and you're going to see more and more applications created. The thing that makes it possible, though, is it's an open protocol. It's an ethical protocol. It's a commodity. It's an asset without an issuer. That means you can start a company in Brazil that builds Bitcoin applications tomorrow. Someone can do it in Nigeria. Someone can do it in China. Someone can do it in any country. You don't have to ask anybody's permission. You can build a new Bitcoin wallet and fail. You can build a new Bitcoin thing and succeed. There's 100,000 different things going on. It's the market economy. And that's the nice thing about a permissionless open network. Most other assets, if it's physical world, like a building, you can't write a software application to manipulate a building 1,000,000 times a second. You can't do that, right? The law of physics says you don't get to do that. And then with an asset like Apple stock, it's a regulated security. You can't write an application in Africa that trades Apple stock 1,000,000 times a minute on Saturday. It's regulated. So the idea of an open network, open to all, permissionless, means that innovation, both business and technical innovation, can happen everywhere in the world all at once. And that's what makes Bitcoin the most powerful, useful, exciting, interesting thing in the world right now.
We explore the fundamentals of financial intelligence in further detail in the second part of our conversation with Michael Saylor. Saylor provides insightful explanations of important ideas that are essential for understanding the intricate world of modern finance. Saylor reveals the subtleties that set the financially savvy apart, from perceiving the actual nature of money to comprehending inflation as more than simply the CPI. He challenges accepted wisdom, asking us to see inflation as a complex vector rather than a single statistic. Saylor clarifies the importance of distinguishing between different types of inflation, focusing on the rate of monetary inflation as the real indicator for investors, and challenges us to think of it as more than just cash. According to time horizons and the store of value function, he supports a strategic approach to cash allocation. Saylor highlights the significance of asset-building techniques for wealth preservation by drawing a careful contrast between credit and money. Let's hear what Michael Saylor about how to deal with changing trends of money, inflation, and wealth accumulation.
To be financially intelligent, you have to understand some key concepts like inflation, like money, like property, like credit, and counterparty risk or risk. So what is inflation? Well, many people think inflation is CPI, but they're not really financially sophisticated. If you're financially intelligent, inflation is a vector. There are many different inflation rates. The rate at which streaming video goes up in price is different than the rate at which Palm Beach real estate goes up in price. And the rate at which an investment asset or a building or a piece of art goes up is also an inflation rate. So you have the monetary inflation rate, the rate at which a market basket of desirable assets goes up in value. You have the PPI, the producer price index. You have the CPI. They're all manufactured synthetic variables. Once you understand that, you have to consider what's in the market basket to figure out whether the inflation rate is meaningful to you. The real inflation rate that matters to an investor is the monetary inflation rate, which is anywhere from 7% to 40%. It's 7% or more in the United States dollar for the last 100 years. It's 14% in weaker currencies. It's 40% in really weak currencies. So that's the first thing you have to understand, because that's the cost of capital. The second idea of money, most people think, well, money is just the currency the government gives me. That's not very financially sophisticated. Money, again, trifurcates into it's a currency as a medium of exchange. It's a unit of account, the world reserve currency. It's a store of value, maybe your building or your investment portfolio. Once you understand that, you have to allocate your cash. If you need the money in the next 3 months, keep it in the peso. If you need the money in the next 3 years, keep it maybe in the strong currency, the dollar, or a currency that's pegged to the dollar. And if you need the money not in the next 30 years, invest it in a store of value, a trophy asset. It needs to meet the Bernard Arnault test. It needs to be something that a guy richer than you, more cultured than you, will want to buy from you in a decade, right? So that's monetary sophistication. And then the rest is just money versus credit. What is money? True money is a non-sovereign store of value bearer instrument, right? That's the best money. And that means I own it and I don't rely upon a government or corporation to make it valuable. Credit is an IOU. And so the question is, do you own money or do you own credit? JP Morgan said gold's money, everything else is credit. Bitcoin is money, but all of the derivatives that you can own are credit if you have to ask permission from the mayor, the corporation, the government to use the thing. So I think if you understand credit risk versus money, and if you understand store of value versus medium exchange, and if you understand the difference between asset inflation and consumer price inflation, then I think you can preserve your wealth. And then you realize that you can't outwork inflation and you can't outtrade inflation. You will fail if you try to work 9% harder every year, or you try to trade and just guess. 99% of the trades won't work right, and 99% of the people can't outrun inflation. So what you need to do is you need to convert the product of your work into a scarce, desirable asset that you can hold for a long period of time. And so if you're trading the earnings you have from work for a product, a store of value product that will hold its value, then you can accumulate wealth and you can keep your wealth. Otherwise, no matter how hard you work, you'll be poor.
Michael Saylor offers insightful and helpful financial intelligence insights. He emphasizes that in order to become financially mindful, one must understand fundamental ideas like inflation, money, property, credit, and risk. Saylor argues against the traditional wisdom that inflation is only related to the CPI by pointing out the variety of inflation rates that have an impact on various asset classes. Investors are better able to determine the real cost of capital when they are aware of the pace of monetary inflation. Saylor also clarifies the complicated nature of money, highlighting its functions as a store of value, a unit of account, a medium of exchange, and a global reserve currency. He advises wise financial management based on time horizons, teaching viewers how to efficiently protect and increase their wealth. Differentiating between money and credit, Saylor underscores the importance of owning true money, which is a non-sovereign store of value-bearer instrument. Understanding the distinction between asset inflation and consumer price inflation is crucial for wealth preservation. Saylor ends by warning against pointless efforts to outwork or outtrade inflation and promoting the conversion of profits into valuable, rare, and long-lasting assets. Following these guidelines can help people build and protect money over time, providing them with financial stability in an unstable economic environment. Until next time, happy investing.